All right, day 21 of my journey to a $500,000 stock market portfolio. All right, so first thing I like to look at is my total equity. So I'm going to start with my margin account. So total equity in my margin account, 7823. And then in my TFSA, 54775. And then in my RSP, 17146. So that's a total of 79744. So I didn't really make any trades to justify this increase. So it's mostly just old positions that have gone up because the general market is going up. I remember my margin account, my equity at some point was at 12,000. Now it's down to 7,800. So this is still considered low. I mean, as you can see here, my P&L in my margin account, I'm actually losing 5,400. My P&L in my TFSA is 8,000 US that I'm losing. And in my RSP, $6,800 that I'm losing. So if we look at my positions real quick, you can see most of that loss is caused by Novavax. And then in my TFSA, most of that loss is caused by Teva and Chesapeake Energy and Immunogen and Grubhub. But Grubhub, I'm not too worried. I think it's going to recover quickly. And in my margin account, most of that loss is caused by United States Steel, Kraft Heinz. I guess Uber I'm not worried about. But you could see how it could reverse quickly. If United States Steel and Kraft Heinz go up all of a sudden, then I fix my losses. Teva as well, and Novavax. I don't think Novavax is coming up anytime soon. Bought it at 39, stock is trading at 5. So this is just, I have to accept the loss. So today I made 2 trades in my margin account. First of all, placed an iron condor on the Qs. So the first 4 lines here, as you can see, I went 30 days out, so until October 11. I chose strikes of 181 and 197. So as long as the Qs stay below 197 and above 181 come October 11, I keep the premium that I collected. And the premium that I collected was $95. And my risk in this trade is the difference between the strikes minus the premium that I collected. So the difference between the strikes is $3. So that's $300 minus $95, which is the premium that I collected upfront for placing this trade. So my max loss is $205. So if I go until expiration and the Qs actually end up below 197 and above 181, I could potentially make a return of 95 divided by my capital risk, which is 205. So 46% in 30 days. So not bad, of course. But most likely I'm going to close the trade early as soon as it reaches a 50% profit. I'm going to close the trade early. So if I collected $95 to open the trade, if I have a chance to close the whole trade for, let's say, $45 or $40, I'll probably close it. So remember, I had an iron condor that I placed expiring September 30th. This one had strikes of 150 and 140. So I need GLD to stay below 150 but above 140 come September 30th. When I placed this trade, GLD was trading at 145. Now it's trading at 140.18. So as you can see, very close to my put side of 140. I had collected $112 to open this trade. And now if I want to close this trade, it's going to cost me $140 about. So I would lose about 140 minus 112. That would be the amount that I would lose on this trade. But as you can see, the call side of the trade, so the 150 side, is profitable. I collected $50 on this trade. And if I want, I can close it for about $8. So my call side is actually profitable of about $42. But my put side is the one that's losing me money because, of course, the stock or the ETF dropped all the way down to 140.18. A possibility, I could close the call side, confirm my profit, and then I'll be left with the put side and wait for it to come back up. Since I have time, I still have until September 30th. Or also because I still have until September 30th, I could do nothing and just hold on and see what happens. Or if I'm really worried about this trade, I can close it out completely, take my $25 or $30 loss on this trade and place a new iron condor a little bit lower. So instead of having 140 and 150 strikes, I could have maybe 137 or even 135 and 145 strikes. Or maybe I could just keep a put credit spread, maybe not sell a call credit spread. So I think because I still have time, it's September 11th right now, and this one expires September 30th. So I think I'm gonna wait a bit, see what happens. But as soon as the premiums here become about $224, I'm gonna close out the whole trade. I'm not gonna let it get past more than double the premium that I collected, because I don't want to achieve max loss. Max loss on this trade is 388. But as soon as I close the trade early, I'm going to place another one to hopefully compensate for that loss. So let's say the ETF continues to fall and it goes to 139, 138, and then the amount of premiums here for me to close out this trade becomes 224. Then I'm going to close the whole trade for 224, and then I'll sell a new iron condor at around maybe 134 and 144 if the ETF is trading at 138, for example. So that would be my plan. So Dell is going up like crazy, 55.48. I plan on closing out this trade and getting my money back at 52.5. Looks like American Airlines as well, same thing on this trade. It's trading at 29. I could probably close it out and get my money back around $28. Goodyear Tires is becoming problematic because I sold a covered call at 12 strike. Stock is trading at 13. So you can see I collected 15 cents, but now to close the trade or to close the option, I need to pay $1.17 if I want to keep the stock, because I paid 14.8 to buy it. So I don't want to sell. I don't want to lose my shares at 12. Probably Kraft Heinz is in the same scenario, big time. Yeah, I have a 27 strike. The stock is trading at 29, but I still have until September 20th. I wouldn't be surprised if the Dow drops 900 points next week. I think I would need that to happen so that I don't lose my shares at a lower strike. If I do end up buying back the call option, I'll just have to add it back to my cost basis. So if my cost is 36 on Kraft Heinz and I end up paying $2 to buy back the call option, well, that's just a mistake I made and my new cost becomes $38. But I had to sell a call option because I don't like to keep my stock. I don't like to hold my stock while it doesn't do anything. It has to generate some sort of income for me. So I decided to sell a call option at a 27 strike. It was the only one that made sense. It wasn't even that much, actually. It was only 10 cents. So it was about $20. But at the time, Kraft Heinz was trading at 25. So it was still $2 away from the current market price, but Kraft Heinz went from 25 to 29 in 2 or 3 weeks. Just my luck. So this here, the Qs, this is the iron condor I placed today. So if you remember my video here on how to make money when a company releases earnings, I talk about a Lululemon trade I did for earnings, right before earnings. Well, I did another one today on RH. So RH has earnings coming out September 10th after market hours. So as you can see right now, we are midnight, September 11th. So it's trading at 154 pre-market, but when I placed the trade, it was trading at 158. So before the market closed, RH was trading at 158. So what I did is I looked at the expected move, which I explain how to get in this video. So go watch this video if you want to see how to calculate expected move. And then I did an iron condor trade because I don't know which direction it's going. I don't know if it's going to go up. I don't know if it's going to go down. I don't want to predict which direction it's going to go, but I know that after earnings, stocks move hard. So I placed an iron condor around the stock at the closest expiry date, which was September 13, which is this Friday. The expected move was about $16. So while the stock was trading at 158, I added $16 to the upside. So that's 174. So as you can see here, I picked a strike of 175 on the call side. So that's my upper range, upper limit. And on the downside, I picked a strike of 140 because the stock was trading at 158 minus 16 gives me 142. So I picked the 140 strike. So my range is 140 to 175. So as long as RH stays between 140 and 175 come September 13, I keep the max premium. Premiums that I collected from this trade was $155. My risk for this trade is the difference between the strikes minus the premiums that I collected. So the difference here is 500, 175 minus 180, so 500 minus the premiums that I collected, which is 155. So my max risk for this is 345. And that happens if RH goes way past 175 or way past 140. So right now, after market, it's trading at around 153. So right now I would be safe, but anything can happen tomorrow or pre-market September 11th, anything can happen. Usually the market doesn't necessarily open the same way that it closed the day before. So really what matters is what it's trading at tomorrow morning. So tomorrow morning at around 10 o'clock, I'll look at where it's trading at and I'll try to close the trade for whatever it's trading at. So hopefully if I collected $155 up front, maybe I'll have to close the trade maybe for $90, $80, who knows. Usually right after earnings, volatility drops. So the premiums, the value in the premiums drop. So I'll be able to buy back the trade for less if RH didn't move much. Or I could wait till September 13 and hope that it stays within that range all the way until Friday, and then I don't have to buy back the trade. I can keep all the premiums that I sold. But then I have a risk, but then that gives me a risk to keep it all the way till September 13, because by Friday the stock could slowly move down all the way past 140 or slowly move up all the way past 175. Although I don't think it's going to move up, I think it's going to go down. Yeah, I risk that it goes below 140. So I'd rather close the trade early. And remember, this will still be a one-day trade. Today I almost bought AMD, another covered call trade. I think it went below $30. I placed an order on AMD, but it didn't get executed. But it was a potential candidate for a covered call trade today. So in my registered accounts, so TFSA and RSP, I'm going to continue to look for covered call trades. I'm going to be a little bit more selective. I'm not going to buy anything. I want to buy more quality stocks that move in a certain range, because I don't want any more surprises or any more stocks that have dropped 20% or even more, like Teva or CHK. And in my margin account, I'm going to try to focus more on credit spreads. So put credit spreads or call credit spreads or iron condors, especially since in my margin account with Questrade, the interest rate is very high. It's 9%. So if I do a covered call trade in my margin account, I'm actually paying interest. But when I do credit spreads, it doesn't use interest because I'm actually collecting a premium upfront. A credit spread is a net credit, so I'm not really paying anything. But a covered call trade, I'm buying 100 shares of the stock and I'm collecting a premium. The net result of the trade is a debit. So in that case, I'm paying interest on the net debit. So yeah, this was day 21 of my journey to a $500,000 stock market portfolio. So if you have any questions, leave them in the comment section below. Like always, if you can open an account with Questrade to trade on the stock market, use my referral code in the description below the video, which you can see here. So use this code to get up to $250 back, which you can enter here when you open an account. Thanks for watching.